Hi, I'm Mlynczyk. I'm a tax partner with Kernutt Stokes. Today I just want to share with you a little bit about estate planning, in particular maybe a few strategy ideas that could help get you going. One strategy, which is a very common one, is gifting. Gifting is an idea where, hey, you're giving away some of your assets now during your lifetime to try to reduce or lower the overall value of your estate. The name of the game here is if we can get the value of your estate down, there's potentially less value there to be subject to tax when you die. When it comes to gifting, it's often understood that I can only give away $15,000 a year. Well, that's not exactly true. First of all, that limit just this year increased to $16,000, and that means I can give away $16,000 with no strings attached. I don't have to report anything on a tax return. I can give it to whoever I want. Very easy to do. Now, what happens when you want to give away larger gifts? Those are called taxable gifts or reportable gifts. Those go on a separate gift tax filing, and there's no tax due when you're making those gifts, but what actually happens is the IRS gives you a lifetime exemption or a lifetime balance in which you can use to credit against and make gifts. If you give away more than $16,000, you need to file a gift tax return and report the amount on the gift tax return. All that happens in that case is you chip away at your lifetime exemption, which is a little over $12 million right now. If you have an asset that has high tax basis in it, means maybe you bought it recently, you could give it away right now, and that would be a good asset to give away. Another very powerful idea is giving away assets where you can take a discounted value for it. Just know that you can give away $1, but only charge 70 cents, if you will, towards gifting. If you sell assets, let's say you own a business and you expect that business to grow in value over the next few years, if you sell it today, you're essentially freezing or locking in that value. So we're freezing the estate, freezing values, and that will potentially help save taxes if you're expecting things to grow. The last one is actually a little counterintuitive, and that might be maybe a do nothing or hold it strategy. And so with holding assets, you're intentionally not giving them away, and you're actually holding on to them so that you can try to achieve what's called a tax basis step up upon death, which is for the benefit of your heirs and beneficiaries. Tax basis step up is a very powerful tool. Let me give you a real simple example. Suppose you bought a stock years and years ago for $100, and now it's worth $1,000. Well, if you hold that stock until death and that stock passes on to your daughter as a beneficiary, well, now the daughter receives a $1,000 tax basis in that stock. When it comes to estate taxes, we really have two taxes to think about. Oregon has an estate tax return which taxes you on asset values over $1 million. And the rate ranges anywhere from 10 to 16%. And now, just this year, Oregon came out with a change, and that tax return is due 12 months after death. Now, on the federal side, the IRS has an estate tax return that taxes you on asset values in excess of about $12 million. And their tax rate ranges from 18% on the low side to about 40% on the high side, and you get to 40% pretty quickly. That tax return is due 9 months after death. So you've got an Oregon return now due 12 months after death and a federal return due 9 months after death with various rates and various thresholds. I hope some of these tips helped you out. Feel free to give us a call, and we're happy to help.